Being a successful trader doesn't mean avoiding losses altogether. It's about controlling your losses when they occur and maximising your profit on winning trades. You probably know that our deal ticket offers stop losses, which can automatically close a trade for you if a market hits a level you specify. But how do you decide where to place your stop loss? We're going to take a look at 3 common methods using our iPhone app to demonstrate. The first method we're going to look at is the 2% rule. Now, many traders believe that you should never risk more than 2% of your trading capital in any given trade. This is because even if you suffer a few consecutive 2% losses, your financial position is still fairly strong when profitable opportunities appear. Let's log into the IG trading app for the iPhone and take a look at sterling against the US dollar market. Let's search for sterling against the US dollar and open the deal ticket to set our stop loss and place our trade. I've got a £10,000 account here and I only want to risk 2% on this trade. That means a maximum of £200, roughly equating to $300. Now, one contract is priced at $10, so if I open one contract and place my stop loss 30 points away, that should limit my exposure to around about $300 or 2% of my account balance. So there we are. The trade has been placed with a 30-point stop loss. Remember that the stop will be activated if the market passes the IG's sell price rather than the buy price, which is what we bought at. Now, it's important to remember that the 2% rule on its own doesn't account for market volatility, unlike some other methods which we're going to discuss in this video. That takes us to the next method we're going to demonstrate, the support and resistance method. A support level is the price at which a market price tends to bounce back up, whereas a resistance level is where the price in the market tends to rebound towards the downside. Support and resistance levels can present sensible places to place stop losses, as they can help you work out how far a market is likely to move against you before recovering. Now, if a market breaks through its support level, it's likely to keep going, and vice versa for a resistance level. So setting a stop loss just below support level or above a resistance level makes sense. Let's take a look at the FTSE 100 market. So let's look at the FTSE 100 chart to see both where we want to place a trade and where we want to place our stop loss. On the 4-hour chart, we can see that clearly we're in a downtrend and the chart is moving back towards the downside, and therefore I want to sell into this market. In terms of an area for resistance and therefore where I want to place my stop loss, I'm going to look at the peak here from the 23rd of September, which is around about 60.70. To give it a bit of room to breathe, I'm going to place mine around about 60.80, which is around about 130 points higher from where the price is currently. For me to sell that, I'm going to open a position with a contract size of 1, and I'm going to place my stop loss 130 points higher than current price. As the market moves in your favour, it's important to know that you can move your stop loss as you go along. So as the market moves lower, I'm going to hopefully place my stop loss lower each time we create a new area of resistance. Our last method is based on the average true range indicator. It reveals how volatile a market is over a specified period of time. A large ATR indicates high volatility, whereas a small ATR indicates low volatility. People use a percentage of the ATR to determine exactly where they want to place their stop loss. Let's take a look at the spot gold market. Let's take a look at the chart for spot gold to see exactly where we're going to place our stop loss utilising the average true range method. I'm going to add the indicator along the bottom, and adding the average true range will tell me on the daily time frame exactly what the average volatility was over the previous 14 days. On this occasion, we can see it's 13, and because I want to place a short-term intraday trade, I'm only going to use 20% of this average true range number. Now, on this occasion, that's going to be around about 3. The market appears to be spiking higher, so we're going to buy it with a contract size of 1, and we're going to place our stop loss $3 lower than the current price. The key advantage of using this method is that it's dynamic and therefore accounts for changing market conditions. You can also move your stop as the ATR figure changes. However, this has the potential to leave you overexposed if you don't keep an eye on how much you're risking. So here we've looked at 3 methods that are often used to determine stop loss placement. When used sensibly, a stop loss enables you to take the psychological element out of trading and instead focus on the technical analysis and your strategies. You'll need to consider your particular strategy and use a method that works for you. Remember that a basic stop loss is not guaranteed, and if the market moves suddenly or gaps against you, you could be closed out at a worse level than the one that you originally specify. To avoid this, you can add a guaranteed stop when opening your trade. This is subject to an additional charge, which we can see here in the form of a wider spread. Thanks for watching, and remember you can find out more about the range of stops available to you on the IG website.